I've got Mr. Sachchidanand Shukla, who's the economist, group economist of Mahindra and Mahindra Group, who is joining us to help us understand that he, of course, is a trained and professional economist, but also has an eye on markets very closely. Shukla, afternoon, we were discussing it earlier, but how much risk would you assign? Because it's important for corporate India, it's important for citizens, all the balance sheets, basically corporate balance sheet, government's balance sheet, and consumers like you and me, our balance sheet. If inflation remains sticky and elevated beyond what we are estimating right now, what are your thoughts there?
So absolutely, Ajayji, I think if you look at the past, and if the past is any useful guide, we have seen such events, and I would want to highlight two such phases wherein inflation has been a stickier problem. One is, and both of these have parallels to what we are seeing today, right? The oil crisis backdrop. So the first one was the 70s when we had the OPEC crisis. And there, inflation stayed high for 3 years, 36 months. And the average inflation was about 15 odd percent in India. The second parallel I would want to draw is, say, Feb 2006 to Jan 2010, when we had 4 years of prolonged inflation, although the average was a bit lower than the earlier episode that I pointed out, at about 8 odd percent. But I think, Ajay, one very important contrast is the growth backdrop. Right now, like you highlighted, the consumer balance sheet is very, very weak, while almost all the variables in the economy have recovered to the pre-pandemic numbers. And mind you, the pre-pandemic numbers are not a great comparison. Recall that GDP growth was just about 4% before the pandemic hit us. So I think even with that contrast, and PFC is still being, say, 3-4% below the pre-pandemic level, we are seeing this inflation problem staring at us. And if this remains prolonged, it can have a big impact on consumer psyche, consumer sentiments. And already consumer sentiments are lagging the business sentiments in India. So I think this can become a problem for corporates who are already dealing with the supply side shock, the semiconductor, the chips, and the entire supply chain issue that we've been looking at. And also, in terms of perspective, this comes at a time when we have lost almost 2 years, right? Even when we talk about pre-pandemic levels being achieved, today we'll have the Q3 GDP numbers, and we will see how various segments of the economy have come back to pre-pandemic levels. But even then, we are still below, say, 10% of the pre-pandemic levels. I'm not talking about the percentage growth. So yes, it is a very tough backdrop. And if you have a persistent supply shock, it will have a negative impact on consumer psyche, consumer sentiments, and corporates who are unable to pass it on will have to take a margin hit.
Right. Mr. Shukla, what probability would you assign that the pace at which rate hikes in US were likely to happen earlier, or how the market was expecting, that pace may slow down a bit, and this entire turmoil in commodity market triggered by Ukraine-Russia issue, it may force the hand of Fed to slow down a bit. And what is market pricing in your view?
So if you look at the expectations in terms of the Fed rate hikes, it has already come down if you look at some of the lead indicators from the US. And definitely, if this gets prolonged, we know that both these countries are having a meeting. I mean, there is supposed to be a meeting today. But in the unfortunate event that this does get prolonged, or they're unable to reach some conclusion, you will see some of the leading central banks dial back their aggressive posture, because you cannot really be dealing with a huge geopolitical event of this nature and also be trying to jack up interest rates. And I think that will definitely have an impact on the rate cycle, as well as the language that some of the central banks will use in future, especially the Fed and the ECB.
Right. Mr. Shukla, there's also one point I wanted to discuss from the market point of view. When there's a lot of, when inflation is surging and when it stalls, So base effect will also start optically showing that inflation is falling or is completely stalled. When is that? Which quarter do you see that happen?
So you're absolutely right. If you look at the base effect, we have the first 2 quarters essentially of the next fiscal having that favorable impact. But Ajay, from a monetary policy perspective, what is important is the rate of change and not necessarily just the level. So, for example, if you have in the last inflation print at 6%, but as a central bank, you believe that the rate of change in certain categories or the overall inflation number is moving up or down, that has a bigger impact on the policy making weights that you assign. Similarly, from markets perspective as well, I think it is the rate of change which has a bigger impact than just the levels. So I would believe that the first half of the fiscal, because of the base, you may get that statistical illusion that inflation is actually coming off in terms of level, but we'll have to continue to monitor some of these variables within CPI. So just to give you an example, if you look at just the aggregate, Russia doesn't seem to be a very big trade partner for India, right? But if you look at select exposure, sunflower oil, for example, the price has shot up from 135 rupees per quintal to about 1500 per quintal, right? And that constitutes about 15% of edible oils. So if you look at this from a variable perspective, you can see prices of soaps, detergents, packaged food, for example, because it is linked to the packaging material costs and cost of laminates, etc., linked to the crude prices. And therefore, you will see some change in some of these variables, and the rate of change is something that we'll have to continue to monitor. If this doesn't get really prolonged or there are no major shocks going forward, you can then probably assign a higher weight to in terms of monetary policy reaction to the level versus the rate of change. So I think this is something that we'll have to continue to monitor. And one very important variable going forward is going to be the monsoon. While we have the SkyMet having come with the first preliminary forecast that monsoon is going to be normal, but in April, you should get a detailed forecast from IMD as well as SkyMet in terms of temporal and spatial distribution as well. So all of these are going to really have a material impact on the trajectory and direction of inflation.
One last question, and that is quality of growth. How are you looking at quality of growth right now panning out? And beyond this calendar, what's your long-term estimate? Have you relooked at your numbers recently?
Yes, Ajay. I think what we will get in terms of the Q3 numbers is close to about 6% in terms of GDP. In terms of components, agriculture continues to maintain its momentum. And like I said, I mentioned the monsoon forecast is normal, the first forecast that we have with us. And also the second advanced estimate for F22 basically projects that food grain output is going to be close to 2% higher. If I look at manufacturing output, that could be a bit soft given the geopolitical shocks and some of the supply side issues. But the favorable part or the positive thing that I see within the components of GDP is contact intensive services sectors, right, which were impacted in January. I think the outlook is getting better with the easing of restrictions and the vaccination coverage. And therefore, if I were to look at the next year, we should be able to get to a number which is closer to 8%, ceteris paribus, right? Beyond that, I think we will have to see how the fiscal and monetary policy tango continues. So far, we have seen both of these being supportive for growth and other things remaining same. And we don't really get into a much prolonged geopolitical tangle or a bigger oil shock. I think we are on course for a 7% plus growth rate thereafter.
Excellent. All right, Mr. Shukla, thanks so much for joining us today. Always enjoy our conversations.
Thank you. Likewise.
With that